What if the Fed keeps rates high all year? How will Wall Street react? Bank of America's Mark Cabana shares a bold prediction. The Federal Reserve won't cut interest rates at all in 2025. With inflation proving stubborn and economic signals mixed, this stance could have major implications for markets, borrowing costs, and the broader economy.
I just don't think that we're going to necessarily get that signal from Powell today.
We talked about that actually yesterday, that they're in wait-and-see mode because nobody knows about the inflationary impact, whether it's just a rise in costs or an actual second derivative rise in inflation from tariffs. Since we don't know that, we're waiting.
Exactly.
So why do we assume that when we get the data, when it does finally come in, why do we assume we'll be able to cut in September? That if we know that it's not going to be inflationary, we can cut in September, then why not cut now?
Well, we're still waiting. We think the market has a bit of wishful thinking as to a Fed that's going to cut soon. There's a lot of political pressure on the Fed, as you know.
Yeah.
Interestingly and unusually, we think we're going to see two governor dissents, or at least one at this meeting, maybe two, from Governor Waller and Bowman. You haven't seen two dissents since the 1990s.
Not Austin, not Goolsbee.
Nope, not him. But we're going to see that from a couple of, at least one other Fed governor, maybe two. And it does just speak to a bit of disagreement within the Fed more broadly. Now, that wishful thinking that the market seems to have about near-term cuts is rooted in a belief that there will be some disinflationary evidence over time, but our economists think that you're going to potentially see July core PCE with a 3% handle on it.
Yeah.
That's inflation that's rising. That doesn't really give the Fed the green light to be cutting anytime soon.
Right, inflation that might be 3% when any of the cracks in the labor market were greatly, the demise is greatly exaggerated. It just hasn't
completely agree with you. The unemployment rate, which is the best single summary indicator of the labor market, especially given the challenges and the changes that we're seeing in labor supply, was last at 4.1%. That's extremely low. The Fed, in their lowest estimate for the unemployment rate at the end of this year, was at 4.3%. So you're sort of out of bounds strong as far as the labor market goes. And to use Chair Powell's words, the labor market isn't exactly crying out for rate cuts.
Yeah, so
right
they could
now.
justify, if they really do have two mandates, they could justify that one seems to be under control. Both of them seem under control, but if one isn't under control, the inflation side would be the one to worry about.
That's exactly right. And again, the bond market seems to be pricing in a lot of cuts right now. We wouldn't be surprised to see front-end yields rise today as we learn that Powell is not going to perhaps justify the extent of the cuts that are priced. Our economists have had a great call. They don't think that the Fed will be cutting at all in 2025. So that's almost 45 basis points that are priced for the year that could potentially come out.
You think there's any way that the Fed could end up with egg on its face from a chicken, whether it's first, I don't know how that works exactly. But do you think, here's the scenario that I'm saying where they could end up looking bad. We really are missing the bigger picture on inflation. And there are major forces in housing or shelter that are coming down, that this is going to be a one-shot deal. You know, companies are going to absorb a lot of it, and you're not going to see inflation. That we're still on that glide path eventually to 2%. And there's no reason not to have loosened because we're too tight right now, really.
That is the risk that they are taking right now.
And it could happen, couldn't it?
It certainly could.
And the fingers would be pointed at them and say, you don't want to be political, yet you were not independent because you couldn't cut, because you had to resist what looked like pressure.
If you look at the stuff in the stock market with the meme stocks that take off and other things,
it's all systems. Yeah, all systems.
So I think that's a great point.
But we got AI controlling why, that's half this market is up on AI.
I think you can ask yourself, how restrictive is monetary policy today?
Yeah.
I think it's a very good question.
Know?
No
one knows.
But if you look at equity markets, I think they're telling you that it's not terribly restrictive.
Right.
If you look at the dollar, it's not telling you it's terribly restrictive. If you look at the labor market, it's not telling you that it's terribly restrictive. So the Fed is taking a risk here in keeping monetary policy potentially
nice to have some dry powder
too long.
Always be, these were hard-won rate increases that were difficult.
It's hard if you're trying to buy a house right now.
But it is hard.
That, but it's also hard if you're a senior and you're saving and you're getting nothing for it if they lower rates. So there's always winners and losers with what happens.
But the way they judge things right now is that the labor market's not crying out for a cut. Inflation is higher than they would like.
Yeah.
They think that they can be patient and wait and see, but the bond market continues to expect some easing later this year.
So you get off on talking about all this stuff?
Yeah.
I mean, is it interesting to you?
It's interesting to me. Yes.
Would you I mean, are there people watching about, recipes on other morning shows? I mean, we just spent 10 minutes micro-analyzing these people on whether they go a quarter.
Oh, Joe, we didn't even really get started because there's a Treasury supply announcement this morning.
You are.
Yeah, you want to get into the Treasury supply thing? I think it's actually pretty fascinating.
Yeah. So I think a lot of bond market people would tell you that that's the bigger risk event today. It's the supply announcement at 8:30.
Explain to everybody what's going on, because I think this actually is a complicated issue.
So the U.S. Treasury issues a lot of debt,
right,
as you know. There's only about 4 times a year when they provide guidance to the market as to what their intentions are with regards to how they borrow, where they're going to be financing, how much they're going to be issuing at the long end versus the short end. And this morning at 8:30 is one of those 4 opportunities.
It'll be all short.
That's what we think.
Yeah.
That's right. And I think you've heard from the president and the Treasury Secretary that they don't want to term out at these rate levels. They think that long end rates are too high. They anticipate that the rates will be moving lower. So they're going to be financing pretty much everything incremental at the very front end. Right. And that's going to be putting a little bit more upward pressure on bills.
So do you think that that's the right decision? Do you think that that's a mistake?
I think that they're headed down a path that's a little non-traditional for them, because it does seem to be a Treasury nowadays that's a bit more willing to try and time the market.
Right.
Most Treasury secretaries will tell you that. Look,
no, they never wanted to do it.
That started under Janet Yellen. They did a lot of this short-term stuff.
They did do a decent amount, especially in the last couple of years that she was there. But we think that we'll be seeing bill levels, which is the really short stuff, that are the highest in terms of percent of the total portfolio that we've seen probably since the early 2000s. Under Besson, unless long-end rates come down more meaningfully. And so we're just looking to see what kind of guidance we're going to get out of the Treasury this morning. As you know, there's been a lot of concern about what the back end of the rates curve is doing and how volatile that's been at times. There are expectations that Treasury may ramp up their so-called buyback programs, where they buy back long-end debt, maybe issue more front-end debt. The market's looking for a signal around that at 8:30. And if they don't get it, there are risks that the back end of the rates curve comes undone.